Is just around the corner, but it's time now for Top Picks with Christine Poole. Top pick number one on this day, Christine, Alphabet, the company behind Google, of course. You like the shares that end in the L, the GOOGL shares on the NASDAQ. Why so?
Yes, so Google has pulled back, almost 32% from its high. So I think it's now trading at a pretty attractive valuation for long-term investors. On fiscal 2023 earnings, it's trading at around 15 times earnings. And if you strip out their cash, because this company has a lot of cash on its balance sheet, it's even trading at a lower multiple. So in terms of online advertising, this is a growth technology name where online advertising is outgrowing other areas of advertising because it's still companies are allocating more and more of the advertising dollars to this medium. And I think, obviously, if we do have an economic slowdown where our economy is slowing and there's economic uncertainty, companies will pull back on their advertising. But if you think it from the perspective of if you have to cut your advertising budget, where will you allocate your dollars to? You're going to allocate it to the most effective medium in terms of advertising. And I think that's what Google represents. They use artificial intelligence to allow companies to effectively target their markets, allow smaller businesses to use that medium to advertise for their businesses. So I think, yes, a slowdown in advertising will affect Alphabet to a certain extent. But relative to maybe some other medians or competitors, they will fare better because companies will pull back on those areas where it's not as effective and allocate and keep the dollars to its more effective stream, which would be for Alphabet. So we've been buying it for new client money here. Once again, building positions over time.
Okay, top pick number two, BCE. You alluded to the fact that you had a big telco as one of your top picks. We always remind people when we speak of BCE that it is the owner of this television channel, BNN Bloomberg, through its Bell Media division. Why do you like BCE?
Yeah, so really that's what I referenced earlier when we were talking, Paul, about income names. So we like BCE. We've held it in our income portfolios, and we've just recently put it into all their client portfolios. We like the yield, which is just under 6%. We think the dividend is safe, and that dividend has been increasing in the mid-single-digit range each year. So that's good, especially in a rising rate environment. BCE and their wireless division, they're benefiting as well as the other telco providers with the increasing roaming, because roaming revenues collapsed during the pandemic when no one was traveling. We're seeing, international and domestic travel ramp up now. So roaming revenues have now recovered to about 90% of what they were pre-pandemic. And so that's a tailwind for the company now. And as well, as I said before, the immigration flow that we're seeing into Canada, the Canadian government is targeting levels of immigration for the next couple of years to get that ramped up. I think that's going to be beneficial for telecom operators because as people come into the country, they will need to have cell phone access and internet access. And as well on the wireline side, they're building out their fiber. They're targeting to have 80% of their footprint covered by 2025. So the capital spending has been ramped up in order to enable this fiber build out. I think once they get there in a few years, you're going to see this company generate a lot of free cash flow. So that's positive for long-term cash flow generating prospects.
Okay, and top pick number three on this day, Dollar Tree, one of the huge players south of the border in the dollar store business, ticker symbol DLTR on the NASDAQ. Christine?
So we've owned Dollar Tree for about a couple of years now. And first, in terms of just the dollar store segment, when there's economic weakness or uncertainty, that tends to generate traffic into the dollar stores. And on their call more recently, they have a refreshed management team. Actually, a lot of executives that were in charge of Dollar General when they turned that company around in 2005 through 2015. And the chairman kind of equated the current environment like what he saw in 2008 and 9, when there was a lot of economic uncertainty related to the housing bubble. Now it's related to inflation. They're seeing traffic into the stores with household incomes around the $80,000 range. Whereas for Family Dollar, they have two banners. Family Dollar, it's typically about $40,000, and Dollar Tree $60,000. So they're seeing wealthier households come into their stores. And so what they've decided to actually do for Family Dollar is to actually invest in pricing to keep that traffic and to really instill a strong value proposition into these new people coming into the stores, and it increases their total addressable market. Now, for Dollar Tree, they're actually, typically in the past, they only had $1 items. It's a very fixed price point. And over the past year, they've implemented a $1.25 price point, so that automatically increases basket size, and it's been well received. And the company has also been switching, mixes its assortment to increase more of a consumables mix versus a discretionary mix, which should be beneficial when the economy is weakening, because the consumables typically outperform versus discretionary. And as well, they are also introducing other $3 and $5 price points to their combo format store. So the introduction of higher price points is beneficial for basket size. And as well, in terms of valuation, when you look at their competitor Dollar General in the United States and Dollarama in Canada, it trades at a lower price to earnings multiple than both of them. Dollarama is actually quite high, in the high 20s, whereas Dollar Tree is kind of around 18, 19 times forward earnings. So I think that there's a potential for valuation expansion as well once their strategies are put in place.